Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I really enjoy having him on about every 3 or 4 months to get his insights on the gold market because he sees a lot of deals come his way, whether they're juniors or large mining companies that need to repair their balance sheets, or juniors, like I said, that potentially want to build a new gold mine. He's a former CFO of Silver Wheaton. Now they're Wheaton Precious Metals. He was their first employee and also the youngest chief financial officer in the history of the New York Stock Exchange for a company with a multi-billion-dollar market cap. And he's the CEO of Sandstorm Gold. Nolan Watson, thank you for joining me.
Well, thanks for having me.
Now, Nolan, before we talk about the gold market specifically and financing for gold miners and your company, let's talk about what your views on the global economy and debt. So in your 2017 annual report, which Sandstorm Gold just released recently, you guys have a really interesting chart in there from the Bank of International Settlements, and it's pretty shocking. The debt basically has exploded since 2008. Why do you think that has been done, and do you think that's sustainable?
Well, the why it's been done is pretty easy to explain. Interest rates have just gone to absurdly low levels, and they've been there for a very long period of time, and it's inducing everyone to borrow more money than they otherwise should. Everyone from governments to fund their deficits to corporations. A lot of corporations in Asia have been racking up significant amounts of debt, and also corporations in North America to do share buybacks and whatnot, and people buying houses and cars. And so at all levels through society and the economy, people are getting themselves significantly over-levered right now.
Yeah, I completely agree. So you think then that this the debt problem that we had in 2008, it was not solved. It seems to have been temporarily papered over with more debt?
Yeah, I think one of the things that I've said on your to you before is that never underestimate the ability of governments to kick the can down the road in terms of solving their financial problems. And that's effectively all they did with the 2008 financial crisis. They kicked the can down the road. Now the problem's worse than it was before, and it's actually pretty terrifying when you think about it. Having said that, the governments can keep kicking this can down the road for a little while longer. I'm not predicting that there's necessarily a blow-up in 2018 or even necessarily in 2019, but there has to be at some point in time, and it's going to be interesting to watch when it does happen. I think one of the things that a lot of people misestimate or don't quite see how things work is when you put that much debt into the system, what effectively happens is that when money starts, or the structure of the economy starts changing, so Fed starts shrinking its balance sheet, the interest rates start changing, so money moves from stocks to bonds, or out of bonds if people are scared of bonds. Just when money starts moving around in a system that is that indebted, cracks start forming, and they form in really unpredictable ways. So it's going to be entertaining to watch. I like watching the economy more than even sports. It's just fun to watch when funny things happen.
And when the money moves around, Nolan, that creates asset price volatility, and we haven't had a lot of that in the last, 4 or 5 years for the most part. There wasn't any meaningful stock market corrections in stocks for a very long time, and now, recently we have that. We have a spike in the VIX, and it seems really since 2008 that there's all these new asset bubbles or credit bubbles that have sprung up in the private sector. So not just governments like you said, but it seems the private sector has taken advantage of these low rates to offer people the ability to borrow that shouldn't probably be borrowing.
No, absolutely. And when those temporary spikes happen, it causes little bits of damage that I think goes unseen to the average person in the economy. So for example, when we had that drop in the Dow of over 1,000 points in a matter of a couple of hours, and the VIX, the volatility index, spiked up dramatically, there would be things like ETFs that were double levered inverse correlation to the VIX. So basically the idea is if the VIX goes up, you lose money. If the VIX goes down, you make money. And the VIX went up so fast that the fund lost virtually 100% of its value in one day and is now illiquid, and they've announced that they're shutting down that fund, and they're going to have to figure out how to unwind all of these complex derivatives, and so they're basically bankrupt, and it'll take them years to unwind all that and solve it all. So just one small crack, but what happens is if people were hedged against that fund, they now owe money to one person, but they can't collect from another. And so problems start spreading when those situations happen.
Yeah, I agree. Those leverage ETFs, the regulators have approved those for retail investors, but most retail investors are not sophisticated enough. They should not be trading in those things because they don't understand what's really behind them. But, I think you brought up an interesting point there with the increased volatility and the currency instability with the dollar. We've seen, a surprisingly weak dollar considering the European Central Bank and the Bank of Japan did enormous amounts of QE in 2017, and the dollar was not strong versus those other currencies. And it seems to me that, asset price volatility and currency instability is going to be good long term for gold.
It definitely will be, and I think we're starting to see that a little bit in our evidence in dealing with institutional investors. So I think that generally right now you can say that there are fewer investors interested in gold than there were a year ago. We're starting to see that turn around, including I met with a large generalist investor 2 days ago who said, we don't really own anything in gold. We're starting to get a little bit nervous about the economy. We think gold is undervalued, that people's attention is going to turn to it. We want to get ahead of the curve. And can we give you $100 million of equity? I haven't had a generalist investor say that to me in a number of years. So I think that people who are early to stories are starting to look to gold because they are getting nervous.
That's interesting. So that would be what a second. You obviously haven't committed to this, but they want to give you additional capital to go buy more gold streams?
Well, that was their ask. We said no, and we get offered money by banks all the time, and we're adequately capitalized to go grow our business. So that's not something that we're going to act on. But nevertheless, it's been a long time since an investor has asked that question directly.
Very, very interesting. Thanks for sharing that little nugget there. So about the gold price, and do you think the gold price needs a weaker U.S. dollar to go higher, or do you think there's other factors that would contribute to the gold price being moving higher?
Well, I think that there are a lot of factors that will have to feed into the gold price going higher. Gold's a very liquid market. Part of it's going to have to be challenges that are happening in the rest of the economy. Part of it is going to have to be the story of increasing interest rates. To take a step back, I think that the whole thesis that a lot of people have is rates are going up are bad for gold, and therefore don't buy gold while rates are going up. I think as we get through 2018, where there probably will be a few rate hikes if everything unfolds as central bankers think it will, once we get through that and you get to the point where there aren't as many expected future rate hikes, that story, that thesis in people's minds goes away and makes them more inclined to look at gold. And so I think that will need to happen. And then gold needs to start getting some momentum because, like it or not, when prices go up, people should be less inclined to buy something, but most investors invest based on momentum, and the higher up the price something gets, the more inclined they are to buy it. So I think gold's price is going to have to start going up a little bit before people start really getting interested.
Yeah, that's a good point about Western investors. They tend to not be value investors anymore because that takes too much time. It takes too much patience. It's mentally uncomfortable. If they're professionally managing money, if they don't meet the benchmark or what other money managers are doing, they are risking their career and being fired quickly. But the other thing is gold is a Giffen good. So if the price of gold rises, the demand for gold actually increases. So it's one of those So it's one of those few commodities or items where if the price rises, the demand increases.
Absolutely.
The other factor, and the thesis that you mentioned there about rising interest rates bad for gold, history would actually disagree with that. So I guess a lot of people that are saying that thesis out there have not really studied financial history that well, because the gold price actually did very, very well under Paul Volcker while he was raising rates very, very high. And the gold price didn't break until Paul Volcker, raised interest rates to around 18%. So there's, real documented evidence out there that the gold price actually does well when the rates are rising.
Yeah, especially in situations where inflation is higher than whatever the risk-free rates are, because when that happens, your real interest rate is actually negative, which is good for gold.
So let's change topics now to the gold mining industry in general. Right now, the dollar has had a little bit of a rally compared to dollar weakness for the last, 14 months or so. And so gold's at around $1,317, give or take, when we're recording this interview on Thursday, March 1st. And so do you think the gold mining industry, are they out of ways to cut costs, or do you think that there's other ways for them to cut costs at their mines?
No, that you raise a really, really good point, and this is a very important point for investors in the mining industry right now, is that all of the costs that can be cut out of mines were cut in 2013, 14, and 15. There's no room left to cut further. In fact, that's been the number one mantra of every successful mining company over the last few years, is just whoever was able to cut the most did the best, and there's no room left to cut. And I think one of the things that I've seen is that people have cut too far and haven't even been spending some of the sustaining capital that they probably should have been. And it's almost like there's a catch-up trade on cost that needs to happen. And at the same time, because the U.S. dollar had, up until recently, had been getting weaker and weaker and weaker, what that means is, most mines aren't in the United States. Most of the mines are in other currencies around the world. And so as the U.S. dollar has been getting weaker, the cost of mining has been going up, denominated in U.S. dollars. And I think that the inflation is starting to kick in many places in the world, including North America, but also, there's not as much deflation in places like Europe and whatnot. So costs are going up materially of mining. There's also a catch-up trade on costs that needs to happen. And so I think you're going to start seeing the all-in sustaining costs of producing gold go up materially in the next 2 years. And unless the price of gold goes with it, there are going to be some companies that start getting squeezed again on their operating margin. So piece of advice I would give to investors is, if you're invested in a heavily indebted gold mining company that has a thin margin, unless you're absolutely convinced that gold's going to go up really quickly here, I would consider switching to a less levered investment or someone with a higher margin.
Yeah, so I was going to ask a follow-up question about, for those gold miners who do have rising costs, how are they going to deal with them? Are they going to have to go out to the market and go raise equity? Are they going to have to do a JV deal with a more well-capitalized mining partner? Are they going to have to sell off, maybe one of the mines that they don't want to sell, but they have to fix their balance sheet? So how do you think then the industry in general will deal with the rising costs if they have had to, spend the paper bear market's been since 2011, if they've had to spend all this time cutting costs and, they've worked very hard to clean up their balance sheet, but now they can't raise capital?
Yeah, it will be all of those things that you just mentioned. Different companies will use different tactics, and different options will be available to different companies depending on their specific situation, but it will literally be all of those things unless the gold price starts running here in the short term.
Now, you did an excellent keynote presentation that you put on your website called "Where Did All the Equity Go?" And so, when the gold price went to over $1,350 earlier this year and late last year, it would seem to me that in the past, juniors would have been able to go out and raise the money. So what do you think is different this time, and why can't a lot of these juniors go out and raise equity now?
Yeah, well, there are a few reasons that are happening simultaneously, and they've been happening for a while, but they will also continue to happen. And the reasons it's getting harder for gold mining companies and gold CEOs to raise capital, there are structural reasons. Things like brokers are there's fewer of them around, just because it's easier to and cheaper to trade on your own, sitting on your own computer. Fewer people have brokers, and the brokers used to be the ones who would be up to date on what stories were hot and which guys had good assets, and they would sort of act as a fund collecting mechanism. And with fewer brokers, there's fewer of that going around. Gold specific active investors, they are a very rare breed now. So there used to be a substantial amount of institutional investors who had large amounts of money that I could go and sit down with and convince them of the merits of a company like Sandstorm, and they could choose to buy or choose not to buy. But a lot of that capital has been pulled out of those funds and moved into passive forms of capital, so ETFs and other forms of passive capital, where they basically just have rule-based investing. And it's usually, the rule is, what's your industry and what's your market cap and what's your liquidity are the only real three things that go into it. And so if you're big enough, you get bought by those funds, and if you're not big enough, you don't, which means all of the junior mining companies, they're too small for these ETFs, and they are completely ineligible to receive any of that passive capital. And so those funds are just simply gone and not available to those junior mining CEOs anymore. So it's harder for mining CEOs to raise money, and that's not just because the gold price isn't isn't doing fantastic. It's fundamental structural reasons related to the finance industry. So it's going to be hard for them to raise capital, which is good for Sandstorm. It's our business is providing capital to mining companies, but it is definitely not easy out there.
And so by good to Sandstorm, you mean it's going to be a little bit easier maybe to attach a royalty if you do help a junior that has a good geologist management team. If you do help them raise capital, they'll be more likely then to agree to some type of royalty arrangement?
Yeah, so when I say good for Sandstorm, a good example would be 9 years ago when we first started up Sandstorm. If we found a junior mining company that had a really awesome, exciting exploration project, and we thought so, well, so did a whole bunch of other bankers and institutional investors. And so if we offered them a royalty finance, some of the really good projects would say, well, I think I'm just going to go do a $10 million bought deal with some junior investment bank, and they would get a $10 million bought deal, and there would be no royalty deal. Well, today, those bought deals aren't available because there's no institutional investors willing to invest material amounts of money into them. And so, I got a phone call this morning from a CEO with a cool exploration project saying, hey, can I do a royalty deal with you? Completely unsolicited. It's a good project, good company. Management has a good reputation, and they just know it's really hard to raise equity out there. So it helps our business find exciting royalties to be a part of.
That's always good, Nolan, when opportunity finds you. You're doing something right then, right?
Yeah, exactly.
So do you think then that even if it's a good junior with a good management team and they do raise some capital, but it seems the industry is struggling to raise the capital to go out and look for new gold mines, this is going to exacerbate the problems then of finding new economic gold mines to replace the mined production and reserves?
Yeah, it was already getting hard just for fundamental reasons associated with the fact that a lot of the easy gold, high-grade gold deposits had already been found, and therefore each incremental exploration program was less likely to find that much more gold. But now when you layer on the fact that it's actually harder to find the dollars to do the exploration project, I really do think that the rate of finding new good mines is going to continue to slow. And it's good for the price of gold. It's not good for the health of the gold mining industry, but it is what it is.
So the CEO of Randgold Resources has been very outspoken for a couple of years now, and in November of last year, in 2017, he gave some comments at a mining conference, and he said basically the whole industry needs at least $1,400 an ounce gold so they can afford to make the investments into juniors and replace reserves economically. Do you agree with what he says, or do you think that number is arbitrary and it's inaccurate?
Well, it's arbitrary in the sense that how do you define what a healthy industry is? I would say that $1,400 gold is a good start. I think that it would be healthier at that price than it is at $1,300 gold. I do think that the industry is going to be able to replace its reserves at maybe not at current prices, but at something marginally higher than current prices. But the industry's ability to replace reserves is again, not just based on price. It's based on investors' willingness to invest marginal dollars into exploration companies. And one of the things that we're seeing right now is that those marginal dollars are very hard to come by. And there's quite a disconnect between the fundamentals of some operating companies and the willingness of investors to invest in those companies. There are some mining companies that are doing absolutely fantastic right now, and they're making good margins, and their balance sheets are strong, but their valuations are at not all-time lows, but 52-week lows and dropping. And so there's a huge disconnect between the ability to get investors' capital invested in the industry and how much money the actual mining companies are making.
Yeah, a lot of mining companies in general right now are really out of favor. There's not a lot of inflationary expectations, especially in Western markets quite yet, but that may change in the near future, especially if the U.S. dollar continues to go down, and despite, the Federal Reserve raising interest rates. So before, I want to ask you now about the royalty and streaming industry in general. So you've talked about this in your investor presentations that you've been putting out for your company, also on your conference calls for a while now, and it seems there's a lot more competition in the royalty and streaming industry. So how much larger is the royalty and streaming industry compared to 2004?
Well, it definitely continues to grow. I mean, in 2004, it was an incredibly small space. The only company of any size that mattered was Silver Wheaton back at that time, and in 2004, our market cap was, I think, $300 million. Today, there's tens of billions of dollars in market caps of streaming and royalty companies, And I do think that the industry is going to continue to attract more capital, and it is going to continue to grow. I think, though, it is showing that we as streaming and royalty companies are changing too in our approach. We are no longer just being one part of the capital structure of a company. So, for example, just providing a stream financing. For example, recently we saw Wheaton Precious Metals do a transaction where they did a stream financing. They took some equity in the company and lent them money under a convertible debenture. And so they're playing in all three parts of the capital structure, the debt, the stream, and the equity. And I think that streaming and royalty companies will continue to show the propensity to be parts of other parts of the capital structure, only as a mechanism to get the stream and royalty. I think that companies like Sandstorm, for example, we know we are a streaming and royalty company. We are not a bank, and we want the vast majority of our portfolio to be just streams and royalties. But if we have to lend someone money for a 3-year period and then get paid back over that 3-year period in order to get a stream that will cash flow for 40 years, then we're willing to do that. And so I think we're becoming more and more relevant to the mining industry and more of a competitor to banks than our industry ever has been before. And we'll continue to attract more capital if we continue to provide better returns than regular mining companies.
Yeah, I think for the industry to continue to improve and for Sandstorm Gold to start to, catch up to the larger royalty and streaming companies, we talked about in the last interview, you guys cannot compete dollar for dollar with them. So you're going to have to be entrepreneurial. You're going to have to think outside the box. You're going to have to be more creative when you structure deals or bring your geologists in to go and find that deal ahead of time like you did with the Hot Maden deal. So do you think then that all this competition is drastically lowering the returns on most of the deals? Because you guys have talked about this on conference calls that now the industry is most of the companies in the industry are kind of okay now with a really low internal rate of return deals, sometimes zero IRR, sometimes even negative.
Yeah, so if you have a mining company that has decided that all it's going to do is sell a large royalty that it already owns on a world-class project, and they go and they hire an investment bank and say, run a 3-month process for me, phone every streaming and royalty company in the world, get them to put in a blind bid on what they're willing to pay at the maximum. Yes, you're right. That is going to transact for a high price, i.e. a very low rate of return, something close to zero, unfortunately. At Sandstorm, we don't participate in those processes. Really, we know that we're trying to get a high return for our investors, and to do that, we have to do exactly what you just said, which is be creative and find other ways to buy those. And so we find it much more productive to spend our time and our technical team's attention going directly to mining companies, uncovering stories that are very exciting and just, for whatever reason, haven't been able to get investors' hearts and minds wrapped around the story yet, and doing a deal directly with the company. For example, last, 2 years ago now, we spent $750,000 buying a royalty on an asset that just about nobody else cared about. And our technical team loved it very much, and the thesis played out. They hit fantastic drill holes. If I were to turn around and flip that royalty, I could probably sell it for $15 million today. So just a massive rate of return. And we would never have gotten that if we hadn't been proactive. And so we're trying to continue to replicate that type of deal.
Yeah, I'm wondering when I know you guys for the last couple of years have been doing those types of deals. So they haven't necessarily produced cash flow yet, but I know a few of them are close and they're moving along the stage towards production. So it's good to see, some of these seeds start to finally bear fruit.
Yeah, no, it's exciting. It's sort of, to make I'm a Canadian, so I'll use a hockey analogy. If you want to have a good hockey team one day, you've got to do it through the draft, and it takes a number of years to stock the farm team full of good players. But if you do it right, eventually you have a team that is world class. And we're trying to do the same thing at Sandstorm with our royalty portfolio, and we've got tons of cash flow coming in from all over the world and lots of growth built into the portfolio. But I think the most exciting part of the company is the part that nobody's paying attention to, which are some of these amazing exploration projects that we're getting very inexpensive royalties on, and they're starting to prove up over time, and a lot of them are starting to get closer to development.
Yeah, there's literally dozens of free optionality components inside Sandstorm where some of these stories a couple years from now could potentially have a mine. I think most people don't even talk about this anymore, but in the Yamana Gold deal, you guys even have a syndication option for a large gold stream on Agua Rica. So that's many years away, but that's a mining district. So there is a lot of optionality in there, whether it's Hackett River and others. So how much optionality, in your opinion, is there in the stock that's not being priced in?
Well, I would say that a good 40 to 50% of our value is now tied up in things that investors aren't paying attention to because they're not either currently cash flowing or actively in development. And for example, that $750,000 royalty that I said I could turn around and sell for $15 million, for accounting purposes, it's still sitting on our books as a $750,000 asset. When we bought Hackett River, we paid $3 million for it, and not too long ago I turned down an offer for more than 10x that, but it's still sitting on our balance sheet at $3 million. So I think a lot of people just don't realize all of the value that is stuck into those things, and that's fine. They will move forward, they will get into development, and people will pay us when those assets are cash flowing.
Now, a lot of people aren't familiar with right of first refusal, so can you give an example of one of those and maybe how in the future that will pay off for Sandstorm Gold?
Yeah, it's a good question. So, as I mentioned before, if a company hires a banker and says, sell this stream of royalty, if everyone can compete on an equal footing for that royalty or stream, it goes for a very high price. So in order to head that off at the pass and prevent those competitive situations, one of the things that we've been doing is going around and when we sign these royalty contracts with exploration companies, building in the concept of a right of first refusal to do a stream or royalty financing in the future if they choose to do that. They might not choose to do it. They might sell the mine before they build it. They might do all equity financing or all debt financing. They don't have to do a stream. But if they choose to do a stream financing, the right of first refusal says that whoever they're going to do it with, before they do it, they have to come to us and say, do you want to do it on these terms? And so they have to do it with Sandstorm if they're going to do it, if we're willing to accept the terms that someone else has put forward. So it allows us to avoid those heavily competitive situations and gives us a long lead into projects that we're excited about.
Will that allow you, with the right of first refusals, if it's a large enough mine, to maybe do syndication and diversify some of the risk and then maybe split up the cash flows further?
Yeah, and that's one of the things that we're starting to build into those contracts too, is this concept of syndication. So we could say, yes, we are electing to use our right of first refusal. We are going to provide you the $300 million of capital to do this and build this large mine for the stream, and we're going to syndicate half of that out to pick a company, one of our peers, so that we don't have too much risk tied up into that.
We'll be right back with Nolan Watson after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. I know you've been talking about syndication for a while, and you did one deal with Franco-Nevada a few years ago on the True Gold, which Endeavor Mining bought which Endeavor Mining took over. So are you surprised that there's not more large syndication deals, that the larger royalty and streaming companies aren't working together more?
I have been surprised that it hasn't happened more. What I can say is my own experience that we have worked on a very significant number of potential syndicated deals, the vast majority of which have failed the due diligence stage, so the deals never actually got publicly announced. But I do see a lot of cooperation between Sandstorm and our peers behind the scenes trying to work together to get deals done to diversify risk, and I think that we'll continue working on that, and we eventually will get some more deals across the line. So investors will see syndicated deals coming. It's been hard to get some deals across the line because, quite candidly, we just don't want to do deals unless they're fantastic assets. And if they fail due diligence, then obviously we're going to walk away.
Now, your most recent deal, which I didn't think you guys would have the capacity to do a deal this quickly, especially after the Hot Modern deal, was the Hyundai royalty deal, and you got immediate cash flow. So how much debt left on your revolver do you have left to pay off?
Yeah, so we drew down $35 million on the revolver to complete the Hyundai transaction. A fantastic asset. It's cash flowing almost $7 million a year, effectively the day after we bought the royalty. And so we're pretty excited about it. But the debt between cash flow from operations and the sale of some of the securities in our portfolio, debt and equity securities, we have that down to approximately $7.5 million. And I'm guessing that in the first week of April, so right after Q1, we'll have that paid down to zero.
That's very impressive how quickly you've managed to pay it off. So I always thought you guys eventually would get to that point where you could do deals this size and just pay it off with cash flow. In the past you had to use the revolver a lot more or actually a lot more share dilution. So you think those days are probably behind you where you're going to have to do a lot of share dilution for growth?
Yeah, well, even companies as big as Franco-Nevada, if they find an accretive transaction and don't have the cash, they still do share dilution, and they trade at 18 times cash flow and 2.5 times NAV. So as long as it's accretive and it allows you to grow your dividend, then sometimes they still do that. But definitely, we're no longer a company that needs to raise equity every time we do a deal. We've got a lot of cash flow coming in, and as long as we find a deal that either our cash flow can take care of or our revolver can take care of it, we don't plan on doing any equity, which is why we're turning down offers for equity financing, even though it is available.
So what types of new deals right now are available for growth in your pipeline? Are they from producing miners that want to repair balance sheets, or are they potentially new mines? Because it seems to me, Nolan, that there's not a lot of really new economic gold mines, although there's a good amount of economic gold mines in Africa, but I'm not really sure if there's that many outside of Africa. So what's your view on that?
Yeah, so the deal pipeline right now is dominated by some exciting earlier stage exploration assets. Those are all small dollars, and we're using the cash flow to pay off debt and start building up a bit of a war chest for the next time we see a large opportunity. We are working on a couple of opportunities that would be for late stage feasibility and development assets, and there's a couple things we're excited about, so we'll see if we can get one or two of those deals across the line, and that the larger deals from operating companies are few and far between right now. There are a couple that we're looking at, but candidly not anything that I'm particularly excited about.
Now, your two full-time geologists on your staff, they've been going all over the world. I've seen the videos that you guys have put out on your website. You send them on due diligence all the time. And so they definitely have to vote, like you said, approving deals. But have they also helped you avoid bad deals like that maybe other royalty and streaming companies took that either blew up or didn't work out, or the mine had to be shut down, or the stream had to be restructured? So have your geologists helped you prevented Sandstorm from any of those bad deals blowing up on you guys?
Yeah, so we have 4 full-time geologists now, so continue to deepen the bench strength on the technical team because it's an important part of our business. The answer is definitively yes to that question. There are a number of transactions that have been done where we had front row center seats to be able to do that transaction, and we passed because it failed our due diligence test, and other companies ended up doing the deal. And generally speaking, they're working out very poorly for the companies that have bought them. And I'm not about to hang any specific one of our peers out to dry by calling them out on it. And generally speaking, we're under confidentiality agreements for the information we find out during due diligence, so I'm not allowed to say what we found and why. But there's a lot of stuff being bought that failed our tests.
Okay, fair enough. Yes, I know you have to sign a lot of non-disclosure agreements. That was frustrating a lot of people when they talked with investor relations and tried to get a hold of you. I know, like with the Hot Modern deal, like the London regulators were really messing up that transaction and your ability to be transparent.
Yeah, if I was able to say all the things I wanted to, life would be a lot more entertaining, but unfortunately there are laws.
Yeah, I mean, being a CEO of a publicly traded company is not as glamorous as a lot of people think.
That's definitely true.
So about the Hot Maden pre-feasibility, when do you guys anticipate that coming out?
So we're just finalizing over the next couple of weeks the expected timing of that. So I don't have a definitive date yet, but certainly I think a reasonable target would be April.
Okay, very good. So there is a lot of news coming. You guys also have it's not Luna Gold, it's now Equinox Gold. There's a couple different company names in there in the restructuring. So it's Equinox Gold with Ross Beatty and what is the Arizona mine, that royalty coming back online by the end of the year, correct?
Yeah, so they're in active construction right now. They're fully financed, and they are giving guidance that the mine will be up and running, and then therefore paying us a royalty by the end of this year.
So I've known you for a very long time when gold prices were high, when gold prices were very low. So I've really enjoyed getting your view in a bunch of different markets, bull market or bear market. So back in 2012 and 13, when things were pretty bad for the gold price, and there were some deals that didn't work out back then, and you were restructuring the company with a better investment checklist, you were bringing on full-time geologists. Is this version of Sandstorm Gold now what you envisioned back then when you began to restructure Sandstorm Gold in 2012 and 2013?
It absolutely is. It's one of the things that we decided to make our calling card is just the massive technical bench strength inside the company, and we've continued to grow that. Just this week, we have another engineer and geologist starting, and we're excited about that. One of the things that we decided to also focus on is counterparty quality. So the presentation on our website, there's actually an interesting slide on it that shows what we were in 2010 in terms of counterparties. So 100% of our counterparties were junior mining companies in 2010. In 2018, 84% of our production is now from majors and mid-tier mining companies. So just an incredible change in counterparty strength, and that is one of our calling cards. And then the third piece that we decided to put a huge focus on is what is the cost of producing gold by our partners? Because it doesn't help us if we're buying gold at $300 an ounce if it's costing our partner $1,400 an ounce to make it, and then another downturn comes along and they shut the mine off. And so based on the asset base that we have acquired so far, by 2022, when Hot Maden's up and running, approximately just shy of 90% of our production will be from majors and mid-tiers. But from a cost perspective, the average cost across our portfolio of producing gold on an all-in sustaining basis and using co-product accounting, not byproduct accounting, which is way more conservative, is going to be around $600 an ounce, which is lower than any of our peers, lower than Franco, lower than Royal, lower than a Cisco. So we will have as good of a counterparty profile as the best streamers and royalty companies in the world. We will have a lower cost of producing golds at the mine than any of the other streamers and royalties in the world. And we have a technical team that's second to none. So the transformation, I think, is effectively complete. And now we've got this fantastic foundation to go build the company with.
Yes, and in your slides for your investor presentation, the Sandstorm Gold geologists, and I don't know if they deserve all the credit, but your partners for streams and royalties, they replaced all the royalties and stream ounces that were delivered to Sandstorm. They easily replaced those last year. So do you think that trend is going to continue with the geologists you have, or do you think that's an anomaly and going to be an exception then going forward?
No, I think it'll continue. 2016 was a year where just about 500,000 meters of drilling was done on properties where Sandstorm has a royalty or a stream. 2017 was a record year. It went even higher. I think it was around 520,000 or 530,000 meters, if memory serves me correct. We're already starting to get the drilling budgets in for 2018 from some of the companies, and it's looking like 2018 is going to set a record even over and above 2017. And, to put that in perspective, that's very similar numbers of meters drilled on our properties compared to a Cisco Royalties' entire portfolio. And our market cap is half of theirs. So for every dollar you get invested in Sandstorm, you're getting twice as much meters drilled on our properties trying to find new gold. So it's a very compelling value proposition.
That's very impressive considering what you've said in your keynote presentation about juniors not being able to raise equity capital for exploration, and also what you said earlier in this interview.
Yeah, if you find the right projects, they will be able to eventually attract dollars, and I think that's what we're going to see. The the world of exploration turn into is real differentiation between the haves and the have-nots. And at the end of the day, it's going to be the number one factor driving who are the haves versus the have-nots is just going to be asset quality.
So after your revolver is fully paid off and you do have some more cash in the bank, which, as you said earlier in the interview, is not going to take that much more time because you have so much cash flow coming in, even though the gold price has had a correction, do you anticipate renewing the share buyback program and continuing that?
Yeah, one of the strategic decisions we've made at the board level at Sandstorm is to always have a normal course issuer bid active and always have a shelf perspective active, so you can issue shares without much notice and you can buy back shares without much notice, and it just allows maximum flexibility for management decision making. And so we will absolutely renew the normal course issuer bid. I think it's just a wise practice to always have one out there.
And ideally, as the company matures more and more of your investments in some of these juniors comes online and starts to throw off actual cash flow, ideally, I would like to see the company, and I've said this on many interviews with you, and I know you agree with me, when the stock is cheap, if there's a correction in the gold price or investors, for irrational reasons or whatever, the stock price sells off, I'd like to see the company be able to do share buybacks, not with debt, but with free cash flow. And I'd like to also see dividends. So, so the best companies, in my opinion, Nolan, are ones that can grow with free cash flow, pay a dividend maybe, and then also with free cash flow, buy back shares when the stock is cheap, although not all the time, do a share buyback with free cash flow, but only be, I guess, strategic with it.
Yep, absolutely agreed.
So about the dividends then, so I know you said on the recent conference call that you are looking into this. So I personally have told you this in conversations. I would like to see you guys wait till 2021, 2022, you have more assets online generating cash flow. I would like to see Hot Mountain online, maybe the gold stream from Oyu Tolgoi from Entree Gold. So once you have, those assets online, I mean, the company is going to be in terrific shape, and you're not going to have to worry about potentially cutting a dividend even if the gold price goes lower.
Yeah, I'm not at a stage where I can openly discuss the dividend policy of the company, and the board is actively evaluating it right now. And at the end of the day, it's not going to be my decision solely. It's going to be a board decision. What I can say is that our board is smart enough not to pay a dividend that has any risk of being cut. So either there won't be a dividend, although I think the more likely scenario is that there probably would be, but it'll be a small enough number that there's almost a 0% chance it would be cut if gold prices dropped. So they're going to be a conservative board, and I think make wise decisions for long-term sustainability.
Okay, fair enough. But the thing that worries me, and you mentioned this, is that when a company does cut a dividend, even if it's only a partial cut or they say it's temporary, the stock price is normally just absolutely hammered. It's like a 20 or 30% drop in the share price within a week. So that would really upset a lot of shareholders.
Absolutely. Yeah, there's no doubt that, well, especially once you start becoming a dividend-paying company, whenever that happens, your shareholder base starts to change a little bit. People who are just super aggressive and all they want is massive high growth, and they don't really care about stability. The types of people that are buying cryptocurrencies right now and trading cryptocurrencies, you start to slowly have those investors on the margin sell their shares to people who want a little bit more growth, but with stability and safety. And if, as your shareholder base changes, if you then change your policy back, you lose those investors, but you don't necessarily gain the old investors back that you had. So, yeah, your share price just gets crushed. And so we're definitely never going to do that.
Yeah, I mean, you guys were already unfairly crushed with the rebalancing of the GDXJ. So, I mean, it's kind of ridiculous with these ETFs rebalancing and stuff. Did you guys even get a warning that they were rebalancing?
Well, there was a long warning. That was actually almost part of the problem. It was the warning that was worse than the actual event, because rather than them selling, I can't remember the number, it was I think 18 million shares. Rather than them just selling 18 million shares, which they could have done because we were a very liquid stock and there are large investors on the margin that would be willing to pick that up at the right prices, months in advance, they say, here's what we're going to be doing, and everyone can calculate the new methodology and go, oh, they're going to be selling 18 million shares. And so nobody wants to own your stock in advance of that until it's happened, and so it disproportionately affects it because your stock drops 15% because they're about to sell shares, but now they still haven't sold the shares, so it keeps dropping, and so just the whole methodology that the ETFs use for those massive rebalancings, I think, is actually to their detriment. You think about this: if you are considering whether or not you want to buy stocks and actively manage your money, or whether you just want to stick it into an ETF, every time an ETF does a large rebalancing, the stocks that they're about to sell tank, and then they sell, which means they lose money. And every time they're about to buy something on a rebalancing, they announce it, the share price goes up, and then they buy after it goes up. So if you're buying on a rebalancing, you lose the increase. And if you're selling on a rebalancing, as an ETF holder, you're losing the money that they lost of yours as it drops. So ETFs don't always follow the performance of the market, because on the rebalancings, a lot of money is being lost by the holders. So it's just I think it's not the greatest way to invest. But anyway, it's a bit of a frustration I have with the industry.
That's very interesting. I didn't know that about what happened with the story behind GDX and GDXJ. But I mean, nothing fundamentally changed at Sandstorm Gold. So it's not. Some people who are not paying attention to markets as much would say, oh, the shares sold off, so something bad must be happening fundamentally, but it was just an ETF rebalancing. So I'm sure you guys got a lot of confused investor relations phone calls.
Oh, absolutely. And it's tough for people to understand, and even people who don't understand why the rebalancings are being done, because in the case of the GDXJ, the reason the rebalancing was being done is because it was too successful. There was too much money being attracted by that ETF, and they were having to continue to buy, based on their current methodology, too many shares of companies. So, for example, they had bought up to 20% of Sandstorm, and by law, they were not allowed to buy more without doing a takeover bid on the company. And of course, an ETF's not going to do a takeover bid. And so they had to change their methodology because they were too successful to basically sell down those positions and start buying large companies. And they redefined junior to include companies like Yamana and B2 Gold and all that type of stuff. So it's a bit of a weird scenario, but we're going to have to face more and more and more of it, because the money is being moved into passive funds continually at a rapid pace. It's something that's, I think, we're going to all have to figure out how to work with and wrap our heads around and just get used to.
So, final question for this interview. We've run a little long, but you provide such great insights. I wanted to keep you around because I know a lot of people who listen to this podcast are Sandstorm Gold investors, and they do like the questions I ask, and they want to hear your insights about the industry and the company. So, in your opinion, why is Sandstorm Gold well positioned right now?
Well, I think we're well positioned for a number of reasons. One is we've got a good team. Two is we've got a strong balance sheet and a lot of available capital, not only the capital that is the cash flow coming in, but the available capital in our revolver, and the available capital that if we found transactions even more than that, we know we could raise equity if we wanted to, even though today we don't want to. And so we're in a good position from that perspective, but we are also in a good position in the sense that it is hard for companies to raise money right now. And so we are actively building out a marketing team to help teach people how to attract investors for themselves. And we have a lot of capital that they need. So we're getting a number of junior companies coming to us with very cool projects, and we're getting royalties on them for incredibly cheap. I mean, we're working on a deal right now where there's hundreds and hundreds of square kilometers of really exciting exploration potential, and the company, I don't want to mess up the deal here, but the company may even be willing to give us a royalty for $1, just so that we will put some equity in and attach our name to it and have our marketing team work their magic. If we can be doing that, we'll be making lots of money for our shareholders. And so the business is strong, the opportunity is good, and we've built the foundation to go and make a lot of money for shareholders with.
And to add to your points there, you have 21 assets now generating cash flow. Your counterparties have improved enormously over the years. I mean, initially, like you said, you guys were just, very entrepreneurial and hustling, and you invented the gold stream. So, I mean, most people aren't aware of this. So many gold streams get done right now. You were the first person, I believe, to actually do a gold stream. There was only gold royalties before that and silver streams. You were the first person to actually do a gold stream at Sandstorm Gold, but you did them on juniors. And so, your counterparties have improved a lot. You have more diversified cash flow. And what most people don't realize is the amount of growth that's already in your pipeline that's already paid for. I think most people don't understand that. They just look at the cash flow you have right now, and a lot of people who don't pay attention to your stock assume that there's not a lot of growth in your pipeline already that's already paid for.
Yeah, and if people are trying to figure out that piece and wanting to also understand the amount of growth that we can specifically identify for projects that are being put into production, they've got some slides in our presentation that show that cash flow growth. Our after-tax cash flow is going to be well over $100 million a year, we figure, by 2022, and that's even with paying a lot of tax, because again, we're the only streaming and royalty company in the world that has structured everything so that we pay tax, and that over $100 million of free cash flow is really about $130 million US of EBITDA, and so we're turning into a cash flow machine. But you're right, there's a lot of optionality that's still not even included in those numbers. So it's fun.
And that's at a low gold price, or the current gold price, right? You don't need a super high gold price to get those numbers.
Yeah, that's at $1,300 an ounce. And so hopefully by the time we get to 2022, it's much higher, not only because we've had more assets turn on, but also higher because of the gold price.
Well, very exciting times now, Nolan. You've talked in other interviews and also on my interviews in the past about getting to that level of self-sustaining growth. What is it, critical mass that you said? So it looks like Sandstorm Gold is either at that level or very close to that level. So I think, the shareholders who have been around for years now, I think the company is about to really turn the corner.
Yeah, we're excited with what we built, and I think investors are starting to see that, and we're getting a lot of positive feedback from institutional investors who have followed us for a long period of time. So we're encouraged, and I think our team is pleased with how things are going.
Yeah. So before I let you go, just talk about the asset handbook and what that is for the listeners out there who want to go and do some more research on some of the potential optionality and other investments the company has made that might not have any cash flow right now.
Yeah, thanks. That's a good point. So our team has spent a tremendous amount of time being able to write down in a book. We call it the Asset Handbook, and you can go to our website and download it. And what it effectively is a detailed description of every single royalty that we have. We started out with the 21 producing royalties. We then added sections for all development assets and all development royalties, and then we have another section for all of our advanced stage exploration royalties. And it describes not only who the counterparty is and where the royalty is and what percentage it's on. We also go down to the detail of actually even physically showing claim maps and where the ore bodies are relative to those areas of interest. And for those people who want to do a very, very deep dive into every single thing we have, all of that information is there and downloadable on our website.
Very cool. I mean, you guys are checking off all the boxes now. I mean, your quality control and your investment checklist has improved so much over the years. I think you guys are about to take that big leap forward in terms of companies. I could see you guys, your market cap going into the multi-billion dollars in the next couple of years, and you might not even need a higher gold price.
That is definitely the goal.
Well, Nolan, I always enjoy my discussions with you. I want to thank you again for your time. And if our listeners want to do more research about Sandstorm Gold, how do they do so?
Yeah, they can call us here at Sandstorm. You can find those numbers on our website, but there's a tremendous amount of material on the website. It's one of the things our team, I think, does well, is provides content and videos and presentations and other information, and you can just go to sandstormgold.com.